Good morning, you're watching Businessworld Live. I'm Danny Lauren.
And I'm Jess De Los Santos. Here are the biggest stories to kickstart this trading day, Thursday. An interagency council is flagging risks to economic rebound, and this includes the continued disruptions in education. The body also says income lost from the pandemic may not be recovered until next year.
The measure easing foreign ownership in telcos and other public utility services is now up for President Duterte's signature.
The country is back to moderate risk classification for COVID-19. That's on the back of a downtrend in new infections.
And manufacturing growth loses steam in January. That's as the Omicron-driven surge hampered demand and production. We begin our broadcast with the Interagency Financial Stability Coordination Council forecasting that it may take quite some time to recover the lost incomes from the pandemic.
Now, the body is also flagging a few bumps to economic recovery. Bangko Sentral Governor Ben Jokno, chairperson of the FSSC, said it may take until the fourth quarter of 2023 to recoup lost income, assuming that GDP will grow by at least 7% this year. Economic managers expect GDP to grow by 7 to 9% this year and in 2023. The council said the damage from the health crisis has been mostly felt by vulnerable households, lower income groups, and non-financial corporations. The FSSC also noted that several issues have to be addressed to sustain recovery. These are public infrastructure, social inequity, and climate change. The council also warned about the continued disruption in education, saying it will have an adverse impact on the labor force as future workers will likely not be fully prepared for the demands of the digital world. Now, the measure opening up certain industries to full foreign ownership is now one step closer to becoming a law. Amendments to the decades-old Public Service Act have been ratified by Congress, which means it will now be forwarded to President Duterte for his signature. Under the reconciled version of the bill, telcos, domestic shipping, railways, subways, airlines, expressways, tollways, and airports have been excluded from the definition of public utility. This means 100% full foreign equity will be allowed in these services once the law is enacted. Lawmakers said the amendment to the PSA bill would translate to cheaper airfare, transport and shipping costs, and internet services. All right, Dan, the local index touched a two-year high yesterday, and even more good news to kickstart Thursday's trade. Was that all sentiment-driven, or are we on the cusp of what we've been waiting for, a bull run?
Sana naman, Jess, it's the latter. Take a look at this wonderful chart from Bloomberg where, it's just optimism all around. You can see from the pre-COVID days, how we were obviously trading way above 7,500 levels, and then a major drop there in the month of March. And then we've just been inching our ways back to that level. And there is really this, strong resistance of 7,500, which if we just manage to break above that, we will be going back to pre-pandemic days wherein we were way above this level. And as it seems, we are having a bit of a struggle, at least this morning, breaking through that 7,500 level. Yesterday, we inched up 1.3%, just barely touching that. Papa Securities did mention it's the anticipation of a reopening play. You've got First Metro's Investments, Tina Ulang, saying the market was euphoric over several positive expectations. You've got January inflation that's coming in tomorrow, and that's likely within the BSP's target band of 2 to 4%. You've got also accelerating corporate earnings. In fact, the rally yesterday was really driven by the lenders. You've got, two of the biggest banks, BPI as well as Union Bank's earnings upbeat there. And then you've got also the loan growth in December story, pretty good. And it's getting better lockdown-wise globally. You've got Europe rolling back curbs, Italy dropping restrictions for vaccinated people. Switzerland scrapping, the work from home issue. So a lot of things moving forward. And let's take a quick peek at the movers here. I wanted to watch out for the airlines, for those that might be benefiting from President Duterte's signature of foreign ownership, moving on to 100% in certain industries. They're not just airlines, but telcos. You can see Globe Telecom in the leaderboard here. Another one that might be benefiting ICTSI, which is, of course, a port operator. And another one that I wanted to look at today is the energy space, especially as Siri is kicking off its offer period that's going to be 6.4 billion pesos of an IPO. This, as they say, the sponsor may double their solar power capacity. And that, of course, is moving as well. The other players in the renewable energy space, you can see ASEN particularly as well, up by 0.5%. Incidentally, AC Energy's Vietnam Investments has forged a share purchase agreement to acquire a 49% interest in Solar NT, and that will be, bringing their total capacity of around 837 megawatts there. And finally, just a quick peek on Dito. That is trading downwards, down by 0.2%. This, of course, as there was a trading halt lifted as they had deferred their share rights offer yesterday. The trading amount or volume had jumped by 520%.
All right, we're a day away from the release of the January inflation print, and the Bangko Sentral says last month's CPI may have been driven by higher prices of fuel and food staples. The BSP factors that could have affected the BSP says the factors that could have affected inflation in January include higher fuel prices and upticks in the prices of rice, meat, fruits, and vegetables due to weather disturbances. This on top of the annual adjustment in the excise taxes on alcoholic beverages and tobacco. The BSP did not give its monthly inflation range for last month as the Philippine Statistics Authority shifts to 2018 as a base year for measuring inflation. The BSP says this shift will allow them to re-estimate their inflation models and to reflect changing Filipino household consumer patterns and the shift to e-commerce. All right, to talk more about inflation and other matters, we have Professor Emmanuel Leyco, economist and president of the Pamantasan ng Lungsod ng Maynila. Good morning, Prof. Leyco. Thank you for joining us here on the show.
Good morning, Chester. Thank you for having me back.
Okay, thank you for joining us, sir. Okay, so what's the inflation picture like, at least from your end, for the month of January, and what do you think are the main drivers here?
Well, they're looking at low inflation around the 3% range, but I think we should be more instructive in terms of what benefits or what angles, what areas of the inflation numbers should we look at. And to me, I think looking at the food inflation should be more relevant than the overall relevant figures, overall inflation figures. So, for example, last time we were looking at 3.6%, but food inflation in some areas were at 8%, 6%. So I think beyond looking at the general numbers of the inflation index, we should look at what matters to most people. So, for example, if your income goes to food, or 80% of your food, of your budget goes to food, the most relevant inflation number for you would be the food inflation. So, for policymakers, let us not just look at the overall inflation numbers. Let's look at what is relevant to our people for policymaking.
Given that, Prof. Leyco, do you expect at least food inflation to remain elevated for the rest of the year, and what could possibly offset that?
I believe so. I think the major casualty of the pandemic is our logistics, and the food supply has been disrupted. I think for the most part that would remain high, and things like major food items, fish, rice, agriculture, that should be a major focus for our policymakers.
Like what you mentioned, Professor Leyco, one of the major industries that has been affected would have to be the logistics sector. But now Restrictions have been eased, particularly in Metro Manila and some provinces, to alert level 2. How much of a lift are you expecting from that?
That would ease up a little bit, but food production is still a major problem. Our agricultural base has not been really that much of a dynamic sector. So we have to look at food production or agriculture in general. Logistics just one of them. So now that the transport is easing up, that would be a good factor to consider for food prices.
All right, Professor Lake, various models here from different think tanks pointing to at least a possible continuous decline in COVID infections here across the country, even projecting a possible end at least to the pandemic here. But given that as well, how does that affect at least your growth forecast for the rest of the year?
Oh, that will be a positive. If we ease up, if the Omicron basically eases up, I think that would be good for the economy. But the question is, are our economic infrastructures, our production ready to get mobilized again? Transportation is a must. If our people cannot go to factories and offices, that will still be a major hindrance to picking up in our economy.
Sir, this is Danny po jumping in on the debt levels of the country. And now, it had been a major issue in terms of the finance secretary saying they didn't want to, default on all the interest payments. We had fiscal space. We did not want to risk a credit rating downgrade, and yet we are racking up 11.7 trillion pesos of debt as of now. Debt to GDP ratio is now 54.6%, highest since 2005. Are you now worried na nawala na tayo ng fiscal space? And at which point can we say that, this still holds true, that we have been disciplined fiscally?
Good morning, Danny. Yes, definitely. I am worried about how our debt numbers are picking up. While they say 60% is a good manageable range that we can look at, 60% of our GDP is not good for a Philippine economy like ours because we're not really that strong. And therefore, in terms of financial, economic space that we are at 60%. We're leaving not much for flexibility. So we're looking at right now, it may not be a problem yet in the next few months or maybe even for the rest of the year, because most of our debt are not short term. Many of them, most of them are mid-term, long-term debt. And interest rate is still not that much of a problem. But I don't think we can relax and say that we can push it up to 60%. And not worry about our debt service. Debt service is a must. It's a mandatory item in our budget, and therefore, if our debt service grows, many of our social services will really suffer.
Where will we get the revenues to service the debt and really as well as, of course, servicing the pandemic and the recovery response? Do we have enough? Are all of these things, we were just discussing the possibility of foreign ownership. Are these all going to be contributing significantly to reaching those or plugging the deficit that's widening?
Governments can borrow. And I think just because they have the power to print money, they have all the money that they can borrow. No, they cannot. You can print money, but that will really stimulate inflation. And the only source really that we should look at would be the revenues of the government. But now that the economy is just beginning to recover, we cannot expect much of government revenues coming from taxes. In fact, we really have to stimulate the private sector production by giving them perhaps tax breaks. But with tax breaks, we are going to lose. We're giving up our tax revenue. So where do we get the money? I don't think we can print money. We don't have that kind of flexibility. So we really have to get the money from social services. We have to realign uh, and put more money in that service because that's mandatory. You cannot walk away from that service. So we will stand to lose more of social services being given to our people.
All right, Professor Leco, talking about revenue stream, you have again Congress, a bicameral at least, ratifying amendments to the Public Services Act, pretty much opening up certain industries here to full foreign ownership. How much of a boost should we be expecting from this?
Well, bringing in investors always good. I will always look at that as a plus. However, we are not the only ones competing for foreign direct investors. Uh, we have many neighbors around us who are also competing, and also how much can we give the foreign investors in exchange for their investments in the country? I am not sure. I don't want to look at it as the panacea to the revenues that we are looking for, no? The revenue problem that we have. I think that should be taken apart from the problem of fiscal mobilization. Do we really need foreign investors? Yes, to some extent we do. But which areas, which sectors should we open up to them? Telecommunications, I think, is ripe for the picking by the foreign investors. But how many foreign investors are looking at telecommunications in the Philippines? There's so much infrastructure investment that we need now before we can really say our telecommunications right now is competitive compared to the telecommunications industry of the other countries who have opened up. So no, I will not hold my breath until we see more of an economic upheaval in the country happening before we start saying that the foreign investors will be here to save us.
Professor Leco, does that same concern apply to the ratification of our inclusion in the RCEP?
I'm sorry?
Does that same concern apply with our possible inclusion in the RCEP? That, of course, is still pending in the Senate. They have yet to ratify our membership in the regional pact. Is that concern about our competitiveness, our readiness also apply with issues in RCEP?
Oh, yeah, definitely. I don't think just being a member will make us competitive. Being competitive really depends on how much we do internally, how much of the infrastructure and how much of the policy environment are we opening up so that investments will be conducive for others. Right now, I think before we look outside, we have to look inside.
All right, thank you very much for your insights again, Professor Emmanuel Leco, economist and president of the Pamantasan ng Lungsod ng Maynila. Thank you, sir, and stay safe.
Thank you, Jester, and thank you, Benny.
Now, coming right up, the country returns to the moderate risk classification for COVID-19. But despite the drop in cases, experts say the public should not let their guard down. And you're still watching Business World Live here on One News. I'm Jess De Los Santos.
And I'm Dani Laurel. Now, the country's COVID-19 risk classification is now back to moderate. This as daily new COVID cases continue to decrease.
The nation's positivity rate has also dropped to 35.4%. That's from a peak of 46.8% last January 18. The health department says hospital and ICU bed utilization is also at low risk. Apart from a drop in cases in Metro Manila, the government also sees a decrease in infections in Calabarzon, Central Luzon, and the Visayas. Despite these improving figures, the DOH warns we still cannot afford to be complacent.
Evolving po ang situation. Hindi po tayo natatapos dahil nagka-Omicron, tumaas, bumaba ang kaso. Hindi pa ho natin alam kung anong mangyayari in the future.
Though cases are on a downtrend, experts say the public should be cautiously optimistic. On One News' The Chiefs, Professor Jomar Rabahante of the UP COVID-19 Pandemic Response Team says Filipinos should still observe health protocols even though infections are declining. This as the country's COVID-19 figures have yet to return to low levels seen before the Omicron surge.
Siguro, we can be optimistic but cautiously optimistic kasi yung alert level 2 po, ang ibig sabihin nito, meron pa ring minimum public health standards. At yun po ang hindi dapat natin makalimutan.
And here are the other headlines we're keeping our eyes on. The country's manufacturing growth lost steam last month as demand and production were affected by the impact of Typhoon Odette and the surge in COVID cases. The IHS Market Manufacturing Purchasing Index, or PMI, slipped to 50 in January from 51.8 in December, ending 4 straight months of growth. A reading of 50 indicates no changes in manufacturing conditions, while a reading above signals improvement. IHS Market says the two cited factors weighed heavily on both domestic and international demand and on companies' ability to produce goods. The firm adds that material shortages and delivery delays also continued pressure on vendor performance.
Electronic exports reached an all-time high last year. The amount came close to $46 billion. That's up by 13% from 2020 figures. The year-on-year increase is also higher than the projected 10% jump for electronics exports. SAPI attributes this to strong demand for new technologies used of AI, work-from-home setups, and telemedicine, among others. The top destinations for Philippine exports in December last year were Hong Kong, the US, China, Singapore, and Japan. And for this year, SAPI is seeing another 10% growth in electronics exports.
The customs collected 58 billion pesos in January, surpassing its target by almost 12%. This was also 23% higher than the 47 billion pesos collected by the BOC in the same month last year. In its preliminary report, the agency said 14 out of their 17 collection districts hit their targets last month as they ramped up efforts to go after illegal imports. The BOC has set itself an internal target to collect nearly 700 billion pesos this year.
And the Philippine Competition Commission reiterates that it wants to participate in the process of allocating broadcast frequencies. That is in order to advise regulators on the implications for competition following the recent award of ABS-CBN's former frequencies. PCC Commissioner Johannes Bernabe said even without an amendment of the law, the NTC could already accommodate the practice. But he admitted it might be good for the law to explicitly provide for the PCC's participation in the allocation of the frequencies.
And that's a first look into the business day this Thursday, February 3, 2022. I'm Jess De Los Santos.
And I'm Dani Laurel. Mask on, wash hands, stay safe, Philippines. We are One News.